Hi guys! So in this video, we're going to talk about personal income tax in Indonesia. But first, we want to explain to you about what NPWP is, which is important and needed for individuals to be able to pay taxes.
NPWP or Nomor Pokok Wajib Pajak is a 15-digit identification tax number. The Indonesian government requires all individuals residing in Indonesia to have their own NPWP tax number, including expat.
Now, who are considered as tax residents in Indonesia? Well, you are considered as a personal resident taxpayer if you have been in Indonesia for at least 183 days within 12 months or have been in Indonesia during a fiscal year and plan to live in Indonesia for longer. Other than that, these individuals are also considered as tax residents in Indonesia. For the first one, employed individuals who earn in excess of the non-taxable income. Second, employed individuals who earn income outside of their gross salary. Third, individual taxpayers who receive income from self-employment and business activities. Fourth, individual taxpayers who receive income from capital. Lastly, for dependent spouses, they are included in their husband's tax numbers and are not provided with different tax numbers. The tax office requires all expatriates residing in Indonesia to register with the tax office. With the tax registration, they can receive their own tax number, pay monthly income taxes, file annual tax returns, pay tax on their revenue earned outside Indonesia, apart from tax paid on extra foreign revenue in other jurisdictions. Now let's talk about personal income tax. So, personal income tax is what the Indonesian government collects from individuals based on their incomes. Income that is subjected to pay personal income tax include employment income, onshore and offshore dividends, interest income and royalties, onshore and offshore rental income, onshore and offshore capital gains.
So all tax residents shall be subject to personal income tax. For non-resident individuals in Indonesia, they are responsible for 20% withholding tax on income generated in Indonesia. As for other taxpayers with NPWP or National Taxpayer Identification Number in the country, the amount of their taxable annual income decides their personal income tax rates.
The taxable annual revenue on individual tax residents is charged at the following progressive rates. The first one is 50 million rupiah or less will be charged at 5%, while 50 million to 250 million rupiah will be charged at 15%, while as 250 million to 500 million rupiah will be charged 25%, and lastly, those with more than 500 million rupiah will be charged at 30%. A significant proportion of individual income tax is gathered through employers withholding. Employers withhold income tax on a monthly basis from wages and other forms of compensation paid to staff. There are several deductions for an individual when determining the personal taxable income. First is individual taxpayer will be deducted at 54 million rupiah, while for the spouse could be deducted at 4.5 million rupiah. Expenses on occupation with maximum of 50 million rupiah on monthly basis will be deducted at 6 million rupiah. And dependents and children up to 3 at 4.5 million rupiah, while BPJS Ketenagakerjaan, employee contribution for savings and old age security, which is 2% of gross income, will be deducted at full amount. And lastly, for cost of pension maintenance, with the maximum of 200,000 rupiah per month, will be deducted at 2.4 million rupiah. However, some foreigners, even if they have lived in Indonesia for more than 183 days in a consecutive 12 months, are exempted from personal income tax in Indonesia because of their unique legal status. These people include the following. First one is foreign diplomatic and consular personnel. The second is military personnel and employees of foreign armed services. And lastly, are representatives of international organizations, which has been specified by the Ministry of Finance. One type of personal income tax is the Article 21, or mostly known as PPh 21. Article 21 states that employers have to withhold tax from the salary and severance payments paid to employees and pay the tax to the state treasury on the employee's behalf.
We'll give you a simple example. An employee named Siti worked at PT AAA with a net salary of 8 million rupiah a month. Now Siti is unmarried and has no dependents, so how's the calculation? So Siti's salary is 8 million rupiah. Then we need to deduct the salary with the office fee. The office fee is 5% of Siti's salary, which is 400,000 rupiah. After the deduction, we get Siti's net income, which is 7,600,000 rupiah. After that, we need to multiply the net income by 12 because we want to find out Siti's net income in a year. 7,600,000 times 12 is 91,200,000 rupiah. Now we're going to find out the non-taxable income or PTKP for Siti. Since Siti is not married and has no family members that depend on her, she got a deduction of 54 million rupiah. Next, we subtract the annual net income with the non-taxable income, and we have the taxable income of 37,200,000 rupiah. Then, to calculate the income tax 21 payable annually, we need to find the 5% of the taxable income. We get 1,860,000 rupiah. Since we want to know the PPh 21 payable a month, we divide 1,860,000 by 12, which is 155,000 rupiah. So the PPh 21 tax in the example we choose is 155,000 rupiah, which is borne by the company and is not added to the employee's salary because it is not included in the gross income subject to tax. So that's our short explanation on Indonesia's personal income tax. We hope you gain more information and knowledge through this video. And thank you for watching!